Welcome to the webinar. Today's webinar is about how to trade an equity curve, an advanced topic.
We're excited to show you that because it just has completely changed the way we're trading, and we're hoping that you'll incorporate it into your own trading as well. So we are CTAs now, and we need to show you our disclosure, so here it is.
It's this kind of in-depth analysis and the drive, the passion to really look at what you're doing that can make the difference between being profitable and being yet another Forex failure. Yeah, it takes a little effort. Sometimes it takes a lot of effort, but that's what separates a professional from an amateur.
And that's why so many professional Forex traders are using our smart tools. They're not into trading Forex for a hobby.
How about you? Okay, snazzy new feature of the trade log, charting, da-da-da-da. And this is available right now. Wherever you see this little red, green, blue icon, and yes, this is a pro feature, not a standard feature. So it's telling us here we're going to chart the equity changes, so I can just click that and immediately I get a chart. And so I know that that's based on this time period. I can click this one and I get another chart. Ooh, not so good that month, huh? And I can click this one and I'm going to look at March. You can also choose to see them based on the number of trades, so that's how we're looking at them now, trades 1 through 22, or by date. And the other places that you'll have access to charting, of course, is in the analysis page. You'll see the icon there, and that'll pull up the chart, and you can get to that on your accounts page. When you pull up, here's that, the edit equity page, and you can go in and see, you can pick any specific date range that you want. You can click on charting from there and it'll pull up that for you as well. And you'll notice up here the three menu items, summary, analysis, and accounts. These correspond exactly to the tabs in the trade log, summary, analysis, and accounts. So this is the trade we're getting from summary and analysis and accounts there. You know, you might say, oh, well, you know, I pull up my MetaTrader statement and I get an equity chart. What's so special about that? Well, think about it. Your chart that you're seeing on that equity, whether that be Forex Tester or your MT4 or most brokers, is just covering all of the trades you took. Now, wonder if you're trading 5 different strategies or 3 different strategies. You have no idea how to be able to pick out which one was good and which one was bad and how the equity graph looked for that particular strategy. Really easy to do with the trade log. You can pick one particular time frame and chart it. You can pick 1 week of the month and chart it. You can pick a day of the week. You can pick some of your specific entry triggers, and if you've noted them while you were inputting that trade information, you can visually compare how those entry triggers did with other entry triggers. You can visually compare one currency pair that you trade with another. You can't overlay charts, not at this time. Question just came in. With that in mind, we want to take a moment and present you with an advanced money management theory called trading your equity curve.
The following 3 charts show the same strategy being used and the exact same trades being taken. So the only difference is all about position sizing and which plan was used. So we're going to ask you now to watch carefully. We're going to show you something that's very, very interesting.
Here's Trader 1. He took this particular strategy and traded it over 500 trades and took his equity from, I think it was 10,000 that he started with, up to 60,000, a 300% return. That's great, isn't it? But now, varying just one thing about how he position sized, he was able to do this. Let's go back and look. Instead of that, his equity curve looked like this.
So instead of 300%, he went to 625%.
And that doubled it.
Same trades, same exact trades. Nothing's been changed.
what about this? Trader 3? She took those same exact trades and she traded her equity curve.
1,000%. Over 1,000%. Same trades.
This is what, people say, oh, money management's so important. And then they just...
Or they say, money management, why bother? Really what I want to know is what's the newest strategy.
Yeah.
I'll go anywhere, I'll travel anywhere, I'll spend anything to learn the next strategy.
Or
really, this is the Holy Grail. The Holy Grail you've been looking for in strategies is here in money management, right in front of you.
Yeah. Okay, so let's see how this difference was made.
We're going to show you how to do this.
And again, these were the same strategies, the exact same trades. The difference is all due to which position sizing plan was used. That's the power of intelligent money management.
Teresa, they all started with the same amounts, okay?
And I want to give special thanks to Mike Bryant over at Breakout Futures. He doesn't trade Forex, but in the course of our studies and becoming CTAs, we've encountered a lot of really great minds, and Mike is among them and has given his permission for us to share this analysis. But it doesn't just apply to futures, it's a principle of trading. So Trader 1, how did they get that 300%? Well, they used a fixed lot size for each trade. They went in with one lot every time they pulled the trigger. Trader 2, like our Forex Smart Tools movie about adaptive Adam, we hope you remember that, he used adaptive position sizing. So he let his calculator automatically update to show his current equity in his account, and then he used the correct lot size to control his risk to be the same with each trade he took. So his position size is not the same, but his risk is the same. If you go to our website and you click on the section Free Money, we call it that because it's like finding money that was stuck under the couch that you didn't get there. Just like what we're showing here about the difference between making a 300% and a 600% return. And this is an independent analyst who's backing up what we're saying here. If you watch these two movies about adaptive positioning, number 1 and number 2, you'll get the whole sense of what we're talking about. And for those of you who own the Smart Tools, these movies are of course in your video library. So everyone should understand these concepts really well, the difference between 1 and 2.
And Trader 3 watched the moving average of her equity chart as she took her trades, and she modified her position size depending on how her strategy was performing in the current market cycle. It's really an easy thing to do.
And Rebecca, this is not compounding. Compounding is miraculous and is also very important. But what we're talking about today is not based on compounding, because all of these traders, let's go back here, were using compounding. That's how they got to 3. That's, the compounding is a miracle. It's sometimes
except he was just doing one lot size. One.
Yeah, but he wasn't pulling money out, so his essential money was compounding. You're right, we're seeing more compounding here with the variable, but this is beyond. This is like standard compounding, about letting your position size grow as you increase your equity, but with a greater precision than just, oh, I'm going to trade more because I have more money. It's the precision of correct position sizing. But what we're seeing here is something else again. So here's how this person got there. You notice that there's a blue line on the chart. That blue line is a moving average, and you're all familiar with moving averages. This is just a simple moving average, and in this case it's a 30 trade moving average. So what she did is, when her equity graph went above the moving average of her equity, she increased her position size. So for instance, instead of risking 3%, maybe she was risking 5%. When her equity graph went below the moving average of her equity, she decreased her position size. So I want to make sure you know what I'm talking about here. I'm going to use this pointer. When her equity curve was in this period, she's not just doing 3% per trade, she's doing like 4 or 5%. When it hits this point and she starts to go into drawdown, she says, market conditions have changed. I'm going to decrease my risk. When it pops up again, she increases her risk again. Decreases, increases.
And that's what she did to increase that percentage. It's really extraordinary. When we saw this, we were just in awe, and we've applied it to our own trading, and the results are extraordinary.
Da, 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 da. And yes, the new Forex Smart Tools Trade Log lets you plot that moving average. For instance, here you'll see that we've plotted a 9-period moving average. You'll find it under Options, and you can say Average. And as soon as you pull that up, you get this chart that says Show an Average. You click it on, and then you can pick whatever time period. Well, it's not time period, remember, it's number of trades. So you can say, I want to average 7 of my trades and see what's going on there. You'll immediately be able to see what that looks like. So if in this test we had increased while we were winning, we'd be way up there in our equity, and then as soon as we started to go into drawdown, then we said, whoa, but let's back off and wait for the market to cycle through. And the market's always cycling.
And you're right, Micah. The calculator, the trade log, and the tester are 3 of the most powerful tools you can be using to trade Forex.
Trifecta. Thank you. It's a great word. So you have to think about your particular strategy to see how well it may respond to trading a moving average equity. We're not saying that it's going to work flawlessly on all strategies, because there's such a variety of strategies. How it works for you and what settings you're going to use are going to be a matter of trial and error and your own experimentation. There's 2 basic camps of trading. There's trend following and there's counter trend. There's those who have a strategy where their wins and their losses come in streaks. When they start winning, then they're oftentimes in a market cycle that really works well for their particular strategy, and they'll see win and win and win and win. And then they may get into a market cycle. Paul, I think you were talking about that with me last month, where a particular market cycle was going on for your strategy that was just not conducive. So you knew you were going to be in a period where you might be taking maybe up to 20 losses in a row, but you knew your strategy was solid and you just keep trading it. Well, wonder if you did this instead. When you started getting into this period of where your equity is dropped under the moving average, you back off. But now think about what kind of strategy you're doing. If you're that kind of strategy where your strategies come in streaks, a lot of wins and then a lot of losses in a row, then you're going to be better to do just like this person that we just showed, where when your equity curve, let me go back a notch. When your equity curve goes above the moving average, you lay it on heavy. When it drops below the moving average, you back off. But now, if your strategy is one that's one of those counter trend or revert to the mean, like how the Bollinger Bands show price coming back to the midline there, coming back to the mean, you might get better results if you do just the opposite. So that when your equity curve goes above the moving average, you're going to back off. You're going to risk less, because you know that after that kind of a win, you usually see a lot of losses. And after a loss, you usually see a lot of wins. So when your equity curve went below the average, that would be a sign for you to increase. So that's why it's smart to differentiate. And of course, you might be having one strategy where you're doing one thing and another strategy where you're doing the other thing. And that's why the trade log is so great, because you can pull each strategy out and look at it and get its own independent moving average.
We hope you're seeing the power of this new addition, because it really can change the way you trade, and it can change your whole bottom line.
Paul's asked, is there an optimum number of trades to use for the moving average? I think it depends on whether you're a short-term or a long-term trader. If you're like kind of a scalper who might be putting in 3 or 4 or 5 trades, 10 trades a day, then the longer moving average is going to be better for you because it's going to reveal more about what kind of a market cycle you're in. If you're more likely on a day chart and you're not putting in that many trades at once, you're better to use a shorter moving average, less number of trades, so that it will reveal more of the market cycle to you. So here we are. We're looking at the trade log, and if you're on the Pro version, you'll see a little red, green, and blue icon in the upper right corner of these 3 pages: Summary, Analysis, and Accounts. So in Summary, it's to the right side of each of the summary bands now. And you just roll over, then it gives you a little hint that says Chart Equity Changes. When you're in Analysis, you'll find it up here in the right under the question mark that takes you to the video library. Chart Equity Changes. And when you're on the when you're in the Accounts page, you'll just click your Edit Equity, which shows you the trade-by-trade balance changes, and you can click Edit Chart right there, and it pops that up.
So if you're already a Pro user, this is included in your Pro version. There's no charge for upgrade. Once you own the Pro, any changes we make are automatically included for you.
Yeah.
These are all just gifts. A lot of these we've done in response to specific traders' requests, and a lot of these new upgrades we're just doing for ourselves, and then we decide to share them with you. So they're all included. Once you own it, you have them. All you have to do is upgrade to the new version. You'll get a message on when you open up your tools that it's time to upgrade.
Okay, so let's field some questions. Okay, there was a question back. Teresa asked, if Trader 2 and Trader 3 are trading their equity curve, why aren't they the same? Did they start with different amounts? And Evelyn answered that about the different amounts, but it's important to understand that what we showed here, we showed the moving average on this chart, but this trader was not using it. All this trader did is just say, as my account changes, I'm going to use the calculator and just use the same risk profile for each time I trade. So it was on this chart, but they weren't making any different decisions as they went into the trade. Whereas this trader was looking at this and saying, I'm going to make a different decision about what my risk profile is. Now, if you're not clear about what we mean by risk profile, when you go back to the calculator, remember that in the setup page, each broker that you set up has this key critical thing that says My Risk Profile. And if you roll over it, you'll get that little hint actually that says how much you might lose based on a 3% risk profile at your current equity. And you can click that little question mark and it tells you in more detail. A risk profile of 3% is comparable to placing a trade on the pound with a 35 pip stop and so many minis. It means that you might lose at most $3,000 if you don't move your stop. So when we're talking about risk profile, it's the most important thing about the money management that you need to know.
That way you can go into every trade knowing exactly what it's going to cost you if you get stopped out. It really does take so much of the anxiety and the fear out of trading, because we were listening to someone this week, it was really interesting, that said that when he goes into a trade, rather than thinking that it's going to win and be a great trade.
Oh, that's Larry Williams.
Larry Williams.
Yeah.
That he goes into it thinking every time he goes into a trade it's going to be a loser. And he said, it's not because I'm not a positive thinker, but if I go into a trade thinking that it might lose, then I'm much more apt to watch it, be proactive, say, maybe even get out before it hits my stop. I certainly won't move my stop. I'm just going to say, okay, I'm ready. I know this is what I'm going to lose, and I'm okay with losing it. Whereas if he goes into it saying, no, 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 this is a winner, this is a winner, I know it's going to win, well, then he might be inclined to move his stop. He might be inclined to stay in it too long. He might hang in it over the weekend when otherwise he would have closed it on Friday. There are all kinds of differences. It was interesting.
Yeah. And Mel asked about what's the time period that's used on these charts that we showed. Well, first of all, remember it's not a time period. It's just, in our charts we're used to thinking of a moving average being a time period. In this case, it's a average of a number of trades. So those could take place over a long period of time or a short period of time.
Again, depending if you're scalping or if you're on a day trader. This
particular graph that Mike created is based on a 30. But remember that was appropriate, something that was picked by this trader based on their strategy. Next question. Does the position sizing in your tools have a way to incorporate your choice of applying this addition? It does not automatically, and Lee asked that question too about can the calculator automatically do that. And I don't know that we'll be rolling that into the calculator because there's so many choices that you need to make about whether you're, remember one kind of trader might be increasing their risk here and another might be decreasing it as it goes above the moving average. So and also you might be, in one account, you might have two strategies that you trade. You might have one strategy that says increase, and you might have another strategy that says when it goes above, I'm better off to decrease. So, at least for now, we're certainly going to just put this idea in your head and let you work with finding out when you're best to do it. Okay, thank you all for attending today, and we look forward to hearing more about your great trading in the time to come. Bye for now.
See you again soon.